to go over and explain the debt consolidation method, and I'll give you an example of 2 credit cards totaling $15,000 of debt, and using this method you'll be able to save $13,000. So first, with a debt consolidation loan using a personal loan, it's going to have a fixed schedule. For example, it might say 5 years of $500, so it's 60 months of $500, a fixed amount every month, and you know that at the end of that term you've completely paid it off. Second thing is, when it comes to your credit score, credit cards are considered revolving debt because you can use them, pay them down, use them, pay them down. A personal loan for debt consolidation is an installment loan because you're paying a fixed amount of money for a fixed amount of time. So a credit report looks at that completely different. With credit cards, it goes towards what's called your credit utilization rate. If you have a credit card with a $10,000 maximum limit and another card with a $10,000 maximum limit, you have a total of $20,000 that you can access. If, for example, you're using $10,000 of the $20,000, then that's a 50% utilization rate. So out of all the credit you can access, $20,000, you're accessing 10. That's 50%. Well, that will affect your credit score. The lower, the better. So let's say you're only accessing 2,000 of the 20,000. Your credit utilization is only at 10%. That will help your credit score. Well, using a personal loan, what happens in this case is if we wipe out that $10,000 of debt on your credit cards, they go to 0. So now your utilization rate is down to 0%. And the personal loan shows up in a different category, which is an installment loan, and you're making those payments on time. That will more than likely help your credit score. So here's the example of 2 credit cards. We have credit card 1, $10,000 balance, credit card 2, a $5,000 balance. The payments are $250 a month on this one and $100 a month on this one, which is a total of $350 a month. I'm going to put a link to the calculator below that I've used so you can use it as well. And 2 things to note here. The interest rate on these 2 credit cards, I've got at 24.24%. You'll see in this image that that's recent. This video is as of March 2024. So between the last 2 months, this has been the rate on average for a credit card. And this is the rate 15.8%, 0.86% for what is considered a good credit score. Not an excellent credit score, not a poor credit score, but a good credit score. You might get a lower rate, you might get a higher rate. It depends when you apply. So that was the second thing. Now, what we're going to do is get a personal loan. We have, in this example, a good credit score. So it's 15.86% for 5 years. That puts the payment at $364, which is just a $14 difference, so very close to what you're making if you didn't get a personal loan. Now, typically, they will charge a fee for getting the loan itself. It can range from 1 to 10% on average is what I saw. In this case, I used 5%. So your total of these 2 credit cards is $15,000. We're going to get a personal loan of $15,000. They're going to add $750. So you're going to have to pay off a little more, but you have a lower interest rate. You take the personal loan. When they give you the money, they typically just put it in your account, and they can disperse it sometimes directly to the credit cards if you'd like. So they can send $10,000 to this card, $5,000 to that card, pay them off. So these go to 0. So now you're looking at the personal loan. Well, let's look at what you would save by using this method. With the credit cards, if you just made your minimum payments and just kept doing that, it would take you 8 years and 5 months, essentially 8.5 years. It would cost you a total, which would be your $15,000 plus the interest. The interest would be $20,000. $20,140. So your total during that time frame would be $35,000 on a $15,000 debt. That's how bad that interest rate is. Now, using the personal loan, so we wipe these out and we make the personal loan payments for 5 years of $364, you end up paying in interest just $6,800. There's the difference. The difference is the interest savings, right? So 5 years, you would have only paid $21,819 instead of $35,000. That's a difference of $13,320. Meaning, by taking the personal loan, wiping out these debts, and paying this loan with the lower interest rate on a $15,000 debt, you literally would be able to save $13,000. That's how egregious these 24% interest rates are. You might look at it and say 24, 15, that doesn't sound like a big difference. Well, in this case, it was $13,000. So below in the description, I'm going to have a link to the calculator so you can put in your debts, and then you can put in, there's a section for the personal loan. You can call up some of these different places. Go ahead and figure out what your credit score is before you call them. Then call them, and usually you can get an idea before they actually pull your credit score. You can say, look, I already know what my credit score is. Generally speaking, what rate could I get? You can call around different places, see what the best rate is, put it in the calculator, see how much you can save. This is a great method, if you can use it, to wipe out credit card debt even faster. That's how it works. It's literally that simple. Thanks for watching, and I hope this helps you get out of debt super fast.